with that, ladies and gentlemen, after extracting some wonderful insights from our speakers here, we're now about to set the stage for our next panel discussion. And this time around, we will be talking about real estate finance strategies, balancing stability and growth. So that's going to be the theme for our next panel discussion. I do realize that this Wednesday, we're all deep diving into a lot of knowledge coming in from this side of the stage for all of you. So stay tuned. And while you do so, I hope all of you are also going ahead and tagging us on our social media handles at the rate RP Realty Plus on Facebook, Twitter, as well as RP_Realty on Instagram. With that, it's also time to invite our next set of speakers, but for that, I have to request the previous speakers to kindly take your discussions in the pre-function area so that we can go ahead, set the stage, and also introduce our next lineup of amazing speakers to focus on the real estate finance strategies, balancing stability and growth. As I'd mentioned, that's the theme for our next session. Let me quickly also introduce our speakers for all of you. Now, this particular session will be chaired by Piyush Gupta, Managing Director, Capital Markets and Investment Services, India, Colliers. And he's someone who's armed with more than 2 decades of experience, who's responsible for developing capital markets business in India. So if I could firstly invite on stage Mr. Piyush Gupta to please come forward. And now joining Piyush on the stage, let me also invite our panelists. We have with us Anuranjan, Mohnot, co-founder and managing director, Gruhas and Lumos Alternate Investment Advisors Private Limited. He's been instrumental for successfully managing multiple real estate funds, including the setup of 300 crore rupees real estate fund for Lalbhai Group, Arvind Limited, as a managing director and CEO. Our next speaker is Amit Goenka, managing director and CEO, NiFCO Finance, and he's someone who brings with him 23 years of top-tier multinational experience in banking, direct investments, and strategy. If I could also please invite Amit Goenka to please come on the stage. Our next speaker, we have with us Sangeeta Prasad, Group Chief Executive Officer, Runwal Group, who's armed with more than 30 years of experience with deep expertise in conceptualizing, strategizing, and delivering urban ecosystems. Moving ahead, we also have with us Anand Lakhotia, Director, Real Estate, Motilal Oswal Real Estate. And having been part of the Motilal Oswal Real Estate since 2014, he's responsible for the deal sourcing, investing, and monitoring as well. And if I could please invite Anand Lakhotia to please come on stage. And our final speaker, we have with us Tina Rawla, Managing Director, CFO, and COO, Hines India. And she's someone who's played a key role in the setup of Hines India residential account and also setting up and stabilization of property management for commercial projects. Now, I do realize this is what happens after every panel discussion. There is further discussion that happens in the pre-function area. We're going to ensure that we bring them back here, but I'd also like to take the opportunity to honor the time of all those who are still seated here. So with that, let's get the discussion started while I do the homework outside and get more delegates to come in and listen to our amazing panelists. So on that note, limited audience, but can we have an unlimited round of applause to welcome our speakers? And let me quickly hand it over to Mr. Piyush Gupta. Over to you.
We start, right? Sure. Thanks, Realty Plus, for inviting us. Welcome all the panelists, audience, and a very good evening to all. I think real estate finance and investment has always been very dynamic and changing with the changing environment. And if at all we talk about last few years, sometimes the regulatory changes which makes the investors and the financing strategies change, whether it's GST, demonetization. At times the market dynamics change. We saw the NBFC crisis, which resulted in different kind of structures coming in, senior, junior, different opportunities throws up. We have now fractional ownership, we have new AIFs coming in. So the business of investing in real estate has been very, very dynamic. While now we have a good sense of market in terms of sales, leasing, but again we have some global headwinds, inflation, interest rates, which are clearly seeing to see the impact. So with this, how do we balance the growth and stability within the investment and the financing space is something which I think will be great to hear the esteemed panelist. Maybe Tina, I can start with you. How are you seeing the overall global investment climate towards India? Yeah.
Hi everyone. The short answer here is that the interest remains strong. It is growing. So I think that we are witnessing that moment in history of real estate investing where everything seems to be working in India's favor. Whether it is, a stable government or most of the asset classes doing well, or the structural reforms that we've seen in the last 5 years, I think everything is working in India's favor. And then you pair it with, increased focus on ESG or innovation. And we have India emerging as an attractive investment destination for global investors. And to top it all, external competition is decreasing because whether it's the geopolitical events, or the events in China, including the downturn of the real estate sector, it has the potential to rewrite the China plus one story. So I firmly believe that the India story remains intact despite the low inflow numbers that have been reported in 2022. It was largely, I believe, because of global investors rethinking their investment strategy or holding off their investment decisions. But once that is out of the way, capital will be back with a vigor.
So in all, we see the positivity which has been there kind of likely to continue.
Yes.
Because of the strong, whether we talk about demand and the way Indian dynamics are. Yeah. Anand, coming to you, how are you seeing the investment opportunities now in India from a real estate standpoint? And are you seeing new structures evolving in the business? What's your view?
So what has happened is post-COVID, the kind of sales momentum which every developer and who are more established, who are more credible have of course witnessed much more sales. So the kind of sales they have seen, now everybody, most of them are in the market because they want to buy land, they want to buy that raw material, and it will take 9 to 12 months to get into production. So last 1 year we are seeing a lot of transactions, lot of acquisitions, and when there are acquisitions there is a need of finance. So we are seeing a lot of proposals, and this is across country. It is not specific to any geography. NCR is also making a comeback. We are seeing now a lot of action in NCR as well. So overall, I think scenario is positive. Of course, now with the inflation and with the interest rate, people have become a bit cautious. But there is a lot of appetite for capital.
Right. Thanks, Anand. Sangeeta, coming to you, if we're developers hat, how are you seeing the opportunities coming your way?
So the fact that I have two gentlemen around me developing alternative structures, the first thing I will say is real estate is always dynamic, agile and evolving. It kind of pivots itself to the new challenges. And yes, prudence, if I see the trend of developers across time, when it was a seller's market, to today when the market has become more dynamic, customers are more agile, aware, prudence is the underlying theme which has made developers stay the long course. So I would continue saying amidst this agility and dynamism, let's be prudent. Let's understand that there are two things which come in our way, which is one is the easier one, if I may say so. Some of you may disagree with me, is the market, but the other is the regulatory impact. When rules change, while the government is trying its best to look at rules of the game, not changing every day, but that plays a very important impact. So while we buy land and while we do our mathematics on the business case, we should be aware, ultimately operational excellence, and I say because I have a manufacturer's genes in me, thanks to my Tata Steel days, long days, operational excellence for real estate has become as important as it can be for a manufacturing company. So between buying land, the time between buying land to development and conceiving and launch and sales is the whole time cycle becomes important. The way you do each activity becomes important. I know I'm sounding mundane, but that's what I do every day, and I think doing it well, doing it again and again, consistently, having processes and quality systems in place, nothing can beat it. And that's what personally I'm doing now where I have joined. The mix of agility and dynamism and standardization and sustainability are the key to buying land and making it fruitful and profitable for all of us. And sometimes we'll go alternatives when we find it useful.
I think Sangeeta brought a very important point which relates to underwriting. I think we have seen this historically that projects have been developed on Excel sheets, funding has happened on Excel sheets, and we have seen what it has resulted in. So the entire, whether it's about underwriting, the costs, timelines, all sales has become very, very important. From that one, Anuranjan, coming to you now, if you were investors hat, how you see the evolving underwriting which has changed over a period of few years?
The first thing which I am noticing right now is that the word prudence coming from a developer.
Yeah.
Okay. And that is where the underwriting becomes very easy. Yeah. And good part that in last 7-8 years, because of this market consolidation and all, handful of developers are there, handful of developers doing same kind of, looking for same kind of asset. The competition is far less, so there is no, cutthroat competition to outbid anybody. So the acquisition is happening at relatively digestible valuation. So this is first prudence. And the second thing is that on lending side also, what I am saying is that from last 7-8 years after all IL&FS and all NBFC crisis, the lenders have become more prudent in the lending, and overall the market is improving for good.
I think important point, Anuranjan, you brought on prudence. Amit, your thoughts on the entire underwriting changes, because I think that is one single thing which has changed, whether it's on governance, sustainability, operational excellence, and your other underwriting aspects on cost and related. How are you seeing the evolving underwriting changes?
So thank you, Piyush. I think clearly everybody knows that capital is the blood for the sector. Without blood there is no life, and so without capital there is no real estate. And clearly the need for, I think, that capital has grown tremendously in the last 2 years. Unfortunately, the supply has not grown as much, which means that the demand-supply gap of money has only widened. And of course, what is getting provided is getting cornered by a few, which means that there's a very significant portion of stakeholders who are not getting capitalized. And I don't see that solving itself very fast. And I'm not saying that those who are not getting capital are not bad, but just that there is not enough capital for everybody. So the bigger boys, the larger developers, the bigger platforms, the people with the certain equations and relationships will continue to gather that capital, irrespective of anything else. So I think that polarization of demand and capital both, I think, is one trend to watch out for everybody. Is, am I going to be able to compete for the same market, for the same product, for the same capital in my city, in my backyard? So I would be very, very cautious about going out and raising more capital unless you're very certain about it. Secondly, I'm seeing this whole FOMO everywhere. Fear of missing out. That sales are so high, I have not launched it. Everybody is raising money, I have not raised it. What am I doing with my asset? Why don't I monetize it today? Everybody seems to be in a hurry to do it yesterday. Nothing happened for 3 years, so let me make everything happen in the next 13 months. I think that's a little bit of a trend that we need to be cautious about. We are very cautious about as to why would you suddenly come back into the market if you haven't been doing much for the last 3-4 years. And again, it brings back to the issue of polarization. So I think as far as underwriting is concerned, I think it's largely an old boys network now. Big guys getting big guys to give capital and vice versa. So I think there's a lot of concentration happening. I mean, we've seen announcements of a new $1 billion fundraise happen, being planned. So enough capital is being collected, enough capital is being tried to. When I say enough, it's obviously still not enough, because I'm assuming there's about $20 billion required, and maybe we have about $5, $7, $8 billion available. So it's still a very large gap, or maybe a little more, but still a very large gap between demand and supply, but it's still all getting cornered. So I think as far as the choices are concerned, clearly it's becoming very selective. Who do you want to partner with? Why do you want to partner with them? Who do you want to give capital? On what terms? I mean, I'm surprised in the last 6 months, people who would have never gone to an alternative, would have gone to a bank or an NBFC, are saying, boss, wo to nahi kaam kar raha hai. It's not happening. So I'm willing to pay a little more, but I need money. So, that's a good trend in one way for us, but it's also a trend which says that, there is concentration and there's dearth of money. And the costs are obviously going to continue to go up because I don't think interest rates are stopping any time. So obviously we have to see the strength of the underlying, not just the underlying, but also, overall sort of financial strength, that what happens if the margins compress, what happens if interest rates rise, what happens if costs continue to rise, will the counterparty be able to sustain that? So this whole test of COVID that happened, a lot of us went through that. We saw who could sustain themselves, who could pay, who were only crying for moratorium and extensions. And I think that is again a very important factor, is there an ability to actually have recourse beyond what is available? I mean, that's a very hard one because most people don't have it. So I just think it's becoming very cautious, very stress test based and very selective. I'm saying we're looking at 3% of the opportunity set that we are getting for our $150 million. So I'm just assuming that maybe, of course, that's not the norm because you're still getting 30-40% of the money that's required, but it's still just 30-40%. It's not even 50%. So my answer, Piyush, is that underwriting is a function of many things now. I think it's more based on worst case scenarios. It's based on stress test. I don't think looking at the last 6 months sales and performance and market absorption is the way to look at the next 3 years. Saying, okay, we sold 200 flats in 2 days, so we'll continue to do that. I don't think those are the norms because interest rates are going to rise. Home loans have already risen by 150 bips in the last 6 to 8 months. So I think those are all indicators of that. There may be a little bit of a pushback by the markets. And I'm a little worried about that. So I think underwriting has become, so of course there are parameters of risk, there are parameters of margins, there are parameters of governance and ESG practices. But I think overall, even beyond that, is the stress testing for the macros.
So Amit, you also brought an important point on the lack of supply of capital, right? And historically, we have seen real estate lacks the supply kind of the kind of capital it needs. It does not have that kind of capital. In last 2-3 years time, we have seen there's a consolidation across whether on investor side or on the developer side. In a way, it's good because you have more better governance system, but still we don't have that kind of supply of capital coming in, right? So what is that, as an industry should do or evolve to, get more capital? And if I compare real estate with other maybe infrastructure or other industries, like in real estate, either land, then you need capital for approvals, and then you need pure development financing. This is a typical cycle, right? But today, if at all we look at number of players, we can just count number of players, right? So what is that industry should do, or how we can attract more capital? And it could be Indian capital from institutions or HNIs coming in, or global capital.
So Piyush, good question, and it's a hard one because I don't think that global capital is interested in India resi story as such. If you see the total amount of money available to residential development by way of FDI, it's maybe 25-30% of the total FDI. So clearly they're looking at long-only assets. Can we go and build a nice commercial building because there's demand and it's a low-cost geography, so there'll be a lot more inbound demand, and that's really the long-only asset. And clearly you're dealing in then a dozen players in the country. That's it. Can I partner with these dozen guys? Can I go out and do this product? Whether it's a warehousing, there are a dozen players. It's commercial, there are a dozen players. And that's the game. That's what foreign capital is saying. These are established players. They have a track record. They've done well. They've shown they've all the check boxes that we need to check anywhere that we would have done in the world. And these guys meet that. So that's really what my opportunity set is. So when it comes to residential, I think there's a lot of innovation that is now being tried by many developers. They're saying, let's do everything. Let's go into a platform deal with a foreign fund. $100-200 million, I'm going to give you a basket of securities. Let me do a platform deal with a large institutional capital provider. Let me raise my own AIF and also become an investment manager. New trend in the market. I mean, I don't know why, but फिर हम क्या करेंगे? मतलब, a little scared, but they're doing that as well. Let me go to IPO. Let me try public markets. So I think the larger resi developers, I think, are trying all taps of money. Because there's not one tap which is sufficient. You can't say there's a bank, there's an NBFC, there's a fund, I'm okay. Despite the strong internal accruals. So I think every possible tap has to be opened at full throttle for them to continue to keep pace with their business plans.
Yeah.
And I don't see any other way. I don't think there's one answer to anything. No, we'll try a narrative, we'll go out and 10 people come back and say, but look at the failures, 10 failures to success. You're out-skewed in terms of ability to guarantee returns and capital. Now with the dollar rates rising and if your capital has to churn every 3 years and you have to take interest rate risk and you have to take currency risk and you have to take macro risk and you have to take political risk, that money is not interested because saying boss abhi dala hai, saying abhi 2 saal mein wapas le lo, then again you will haggle for exit premium, say okay, can you get out at 16%, why do you want 18%? So just too much of operating risk for commensurate returns for that money. And it's not interesting enough. It's not interesting enough for anybody. So it's only domestic capital finally said, chalo, theek hai, it's my money, it's Indian money, I don't have all those issues. Because whatever happens, happens in the country. So they are the only people effectively who are able to. Yes, there are two large banks which have capital, but sab mila ke $3 billion.
Yeah. Anuranjan, I think you were raising to, and specifically, you've been now so connected with the domestic local investors. What is that one can do to channelize capital coming to real estate?
I think the biggest challenge which we see, domestic or offshore, and offshore particularly, the dispute resolution process in India is probably one of the worst. If there is any dispute between an investor and a developer, it will take years to resolve. And that is where, the predictability of partners becomes very important. And as Amit mentioned that, there are a handful of developers with whom anybody can work because these all are tried and tested. 10, 12 in a country like India is very bad number, We have at least 3,000, 4,000 developers in Mumbai alone. And we cannot deal with these people. Why? Because the reason is that, you don't see that if there is a dispute between partners. Sorry.
Is audible, no?
Am I audible?
Yeah. Sorry.
So if there is a dispute with any developer, it will take, long time to resolve it. And by that time, if I'm an offshore investor, the currency will be completely different, the profile will be completely different, and then these all developments related risk, why I need to invest. So unfortunately in India, in last 10, 15 years, particularly I will say 10 years, the risk capital has not come. The capital which has been invested in India is more of income building asset and core assets. You put money, you take the ready asset and move on. That's it. And they are happy with the yield of 6, 7, 8%. Of course, they have made more money on that. But thing is that they don't want to take any development risk. They don't want to deal with a developer in development process. This is the biggest problem because the dispute resolution is really, and then there are permission related issues and all. Again, a nightmare. So what we need to do is that two things. One is we strengthen our dispute resolution process. We need to improve. We need to really see a single window process of approval. And then, yes, of course, then it's more of market risk, more of, a capital risk, what you do, while developing a project. So that's the key thing, In India, we have more than 5 lakh units which are, stalled and, delayed, seriously delayed. And it's from years. Now, if we have to resolve those, ideally it should all be resolved within 6 months to 9 months. And all these should be available for, development, redevelopment and so on. But the issue is that, it's not happening from long time. High Court, Supreme Court, Tribunal, consent, this, that. And ultimately customers as well as the market is suffering. Lenders are suffering. And if a lender who is, coming from outside India, if he sees that, my money is stuck in a project in JP and not able to recover for so many years, why I will do it?
But at least that there is, with the IBC process, there is some resemblance where things are moving for good. We may have not achieved the desired results, but we are seeing kind of solutions coming in not only real estate, over a wider industry.
I think, see, IBC is great. No doubt IBC is, it's a specific act to resolve things. What we need is the speed of that implementation of that project, nothing else. So it has to be, if the act has said 6 months, within 6 months resolution should be there, then in 6 months resolution should be there.
Sangeeta, maybe your thoughts on how a developer is now planning his growth strategy. At one end, we have maybe limited capital, maybe there is more for office and logistics, but very limited for residential, and equity maybe does not exist in residential. There are various options for different structures for a developer, doing a joint venture, there are so many options for development management. At this point of time, for a developer to grow, what is the strategy to, what would you do at this point of time?
So, as Amit said earlier, there aren't too many who are in the fray. So, and the ones who are in the fray are serious. And over the years, as I said earlier, some rules of the game have been understood, and they have also pivoted to understand that खाली ज़मीन खरीद के उसके ऊपर सामान नहीं बना के नहीं बेचने से हम लोग endure नहीं कर सकते. So the rules of the game are fairly similar. It's how you brand yourself, how you understand your customer. That's where the difference comes in. Now, as far as land acquisition is concerned, there are various structures. What we are seeing is ultimately what is your brand coefficient in the market is what an Amit or an Anuranjan and anyone else, Anand, will see. Is this they are also playing the game of prudence, because people have burned their hands and fingers and everything earlier. So it's a very symbiotic process. I'm confident that the serious people who are in the fray and have understood that the game has to be played in a responsible manner. So I just would like to tell the co-developers here, whoever is sitting, we cannot take things in the external environment frivolously. Whatever we have done in the past may not be what we will do in current and in future. It is prudent and understanding that we need to know the customer is always right, the government is always right, and if we understand these two variables and go to an lenders are sometimes a little quirky. You please note, I didn't talk about lenders. So, and if you are good, then you have your choice of lenders. If your operational excellence is done, your brand is doing well in the market, and you play the rules of the game, we can choose between all three of them, and maybe sometimes her in commercial.
Yeah. So before we come to Anand, your word as a CFO of a developer stroke investor, how do you control your investment guys? What would you do to control your investment guys? What not to do in the current market situation?
Well, what not to do is not to take unnecessary risks based on trends. So, for example, like Amit said, we have to approach the residential underwriting with a lot of caution despite the prevalent upbeat scenario. There are learnings from the past that we have to bake into our underwriting. What we look for besides track record and reputation is, the ability to deliver to a certain standard or transparency or high governance standards and the ability to stick to a business plan. I think that is what we all must focus on to be able to deliver the returns that we underwrite to. And currently I see that there's a large divergence in Indian developers between haves and have-nots. The haves have a lot of access to capital, whether it is the public markets or private equity or domestic capital, HNIs, family offices, NBFCs. At the same time, the have-nots are struggling and are picking up capital at very high interest rates. And that's largely because of, their inability to deliver to standards and, corporate governance.
Thanks, Tina. Anand, your thoughts?
No, so I think capital is available, as everyone mentioned that if you have done it right, if you know your games, your rules of the game, you know that this is, you have to, as operational excellence has to be there, as Sangeeta mentioned. So I think capital is available. Yes, equity capital, there is limited equity capital available. Both from an investor perspective also, if I am going to raise a fund where I tell that I will do pure equity transactions, investors are also averse. I may do selective equity transactions. At the same, the developers as well, given the euphoria and given the success they have enjoyed in last 2 years, they are also averse to share their profits. So they also want to take debt and restrict. And because they feel that this will continue and the markets are turning around, the markets will continue to do good. So why should I share my profits? This is what I should earn, and limit the lender. So I think there has to be a balance on both sides. The developers also need to understand that this is not, there can always be suddenly the markets can change. So that's it. So I think it has to be a balance between investor and developer.
It's like when equity is available, Sangeeta will not take it. Yes. And when Sangeeta needs it, you will not give it.
Exactly.
Yeah.
So there has to be some balance between my expectation and her expectation.
Anand, I completely agree with you. Whenever you want to share the risk and share the rewards, the risk is yours, the rewards is theirs. So I think that is a big dichotomy, and I would just say this to everybody that, boss, if somebody is willing to say ki, bhaiya, I'm willing to write off the interest, but you give me a share of the upside, do not hesitate. Everybody thinks ki, yaar, abhi to 50,000 is selling for 1 lakh, or what was that 15,000 is selling at 30,000, so I'm going to make a multiple on my money. But boss, the guy who's giving you the money also needs an upside if you're going to make money. He's willing to write that with you. So why do you want to cap his returns if he's willing to take a downside risk with you as well? So I think that whole mindset of I don't want to share rewards has to go away. Otherwise, boss, capital is not interested. You can't make all the money and take all and leave all the risk at the capital end. So I think that's a very important point. And please consult Piyush before you take capital. He'll tell you when not to take money also.
Piyush,
No. So just Amit, a related point. For a stability of any business, it needs equity, right? And real estate, for a long period of time, it has grown purely by leverage, or customers like we all have funded developers' growth. Now, what is that we can do to get equity in real estate? Today whatever equity we have, it's not equity, it's all debt. We all know, right? So, is there a demand? The answer is yes. Is there a need from a long-term stability? Even that answer is yes, right? What is that, a comforting factor from an investor perspective can come in to deploy capital? See, returns are always a function of risk, right? So it's, if a 20% returns one get, it's a good return. Just because by, our nature we thought real estate 20% milta hi hai, to main equity kyun karu? But 20% is a good return.
I'll tell you, India investments are actually all equity investments. Nobody comes to India saying I'm going to earn 10% in rupee terms on debt returns. People come here to make a multiple because of the growth story. Can I put money in India and take out 3 times, 4 times, 5 times in 3 years, 5 years, 7 years, 8 years? Nobody's coming to India for the short term. There are enough safe havens in the world where if you want to earn those returns, you can actually park it for the short term, get your money back and be happy. Everybody in India. So if you look at the amount of money that private equity is giving to startups, we all think, yaar, usko milta hai, mujhe kyun nahi milta hai? Sab sochte hai ki nahi? यार छोटा पैसे के लिए इतना डॉक्यूमेंट करो, इतना जार घूमो. I mean, what these startup young boys are getting money. But remember, why are they getting that capital? Is because it is a growth environment. They are targeting a sector, a service, an opportunity which is very high growth, 300%, 500%, 1000% year-on-year growth, because they all want multiples. So if you are able to create a platform, saying, okay, I can show you a 5-year growth story. I have land bank A, B, C, matured, this is my track record. I'm able to do this, deliver it. In 5 or 7 years, this is the multiple that you can hope to make, and this is the part to it. I don't see why people will not be interested, because more often than not, my LPs, especially people who come from offshore, don't ask me for ki kitna taka return milega. Nobody asked me this question. They said, how much will I take back as a multiple in 5 years? Will I take back 1.8x, 2x, 2.5x? If any of us in this room can answer that question, that this is the multiple I'm able to provide, there's enough money available. Second of all, you've seen enough platform deals. Recently, Mahindra announced another continuing partnership. I mean, you've seen it, you've lived it, so why are they getting it? You know, all large developers should have found Keppel Land, Actis, somebody else, GIC, they've all formed partnership. That is equity money. It's all equity money. So why are they getting it? Because they have a continuity, they have a portfolio, they have a business plan. They can show that this money can be deployed. $50, $100 million can be employed and returned back in 5 years. If you have that scale, you don't go to IPO with 50 crores, no? Do you do an IPO for 50 crores? You don't. Likewise, you don't go to equity market for 50 crores. You go to equity market if you've got a $100 million requirement. You go to the IPO if you can do 700 crores, 1,000 crores, no? You don't do 50 crores IPOs. So it's the same thing with equity. Whether you go to public markets, you go to private equity, if you have got size, if you've got scale, if you've got continuity, there is capital available. There are enough people who are wanting to find that next bet. They've already taken bets on the top 10 guys in the country. Where's the next bet? It could be any of us. Do we have the ability to think for the next 10 years and demonstrate that, yes, we have the infrastructure, the land bank, the history, track record, and the systems to actually deliver for the next 10 years without fail? Why there's no money? Of course there's money.
Yeah. No. So coming to you, Sangeeta, from a developer's thought process, what stops them from taking equity? At one end, they are saying there is enough equity available for players, and from a growth demand perspective, everything remains strong, right? Still, developers refrain from taking it, and this is more to real estate specific. Other sectors, we see a lot of equity coming in at all the stages. From a developer's mindset, is it just by that, okay, I don't want to share returns? What is the mindset of developer?
I guess you're right when you say that, because the first thing a developer who's doing well and generating, as I said, my whole hypothesis is operational excellence and cash flow management are the key success factors for any developer to endure themselves through thick and thin. So you're right that if I have it in me, I will choose, because as you can see in this panel, there's one developer and one quasi, and the others are who put money in. That shows the balance of play in the realm of real estate. So developers who know how to play the game, they are choosy, they are selective, because then if I can do it myself, and I'm not being arrogant here, I will be prudent. And I use prudence not only in the way I conduct business, but in the way I choose my partners. Because if I have to give you 1.8x or 2.2x, I might as well see what I can do better so that I get what I want. So it's not that we don't want to choose financial partners. It's not that we are averse to it. Platforms are there, even in Runwal, in our commercial space as well as in our retail space and residential. We have partners. It's not that we are not averse to it, but you have the right to be prudent in all realms of your game, and the idea is to make your game better and better every day and choose the partner which works well for you. So there's no aversion, it is a strategic choice. And when the strategic fit doesn't happen, because one of the other things I would like to bring here, and from my past experience as well as here, is the qualitative fit. One is the quantitative commercial terms of the game. If you and your partner do not have qualitative and strategic fit, it can lead to mayhem, because you both don't know what you want together. You want things separately. So we were having a review with one of our private equity partners, and then we had a long discussion on how the launch will happen. So it's not that they meet us every day. So we have a very lucrative, project which is doing well, and the whole launch release strategy was being discussed. It was a very, very productive discussion, and I was very happy. I told him, aapke muh mein ghee shakkar, what I'm trying to tell my team, they will listen from you and they'll know that you have put in equity, so they will listen to you. So sometimes with a partner with whom you have strategic fit, they actually become your ally. So it's very important to decide who to choose, not only from a quantitative perspective, but from a qualitative strategic fit perspective. That's why these relationships are few and they can sustain if both these parameters work. So don't choose without discretion, use discreet, be discreet and discreet.
So Anuranjan, coming to you, for selective names and area comfort, would you open doing equity?
In past, we have done deals with the first-time developers, equity deals. The experience was good, and in fact, really, really good. What I believe right now, what is happening is the debt is available very easily, and while lending, most of lenders are not seeing the group level leverage. So what they say is that the project level leverage is like 80%, 60%, or 90% if it is lent, to any project. It's fine, they will manage the risk. But the group level leverage, most of time it is getting ignored. And that is where the problem lies. As soon as the lenders stops this particular, they start seeing the group level leverage, the demand of equity will again come, and then, we'll see more of equity and more of equity deals. Now, right now, that is always looking cheap because the market is growing. So demand will not come. Demand of equity will not come. Demand of equity will come only when we start looking at group level debt exposure and group level leverage. Since demand is not there, the supply is also having its own issue. So it's all mix and match. And in India, hardly 10, 15 developers are getting so-called equity money. So this has to improve. We are growing an economy. In next, say, 6-7 years, if we are a 6 trillion economy, and if real estate is 15%, so we are talking of $1 trillion kind of real estate market. In that, if that is the only thing which is available, we are gone. We are gone in that case.
So
How
Anand,
much leverage will do? That is what we are saying.
Yeah. So Anand, coming to you, as an investment house, how would you distinguish between debt and equity? One way, obviously, committed returns is debt, right? Open-end returns is equity. But 18 or 20% debt under return deals will carry all equity risks, right? So how are investors? Is that view of investors changing? That it's just committed returns is debt and open-ended is equity, or is now it's more what risk am I taking, irrespective how I'm going to get my money back? Because we have seen historically all the debt has become equity by default. Yeah. So is there a change in thought process of the investors?
No, so I agree that debt has become equity, and I think today also while we are doing committed transactions, the way everyone, I think all lenders have become very prudent, and the way they go about asset management and in getting regular updates from the developer, the management is as good as equity, and every lender now knows that if the project performs, then only I get my money back. Else it's a task to get my money back. So whether it is debt or equity, I think the level of governance, the level of engagement with the developer has gone to a different level. So that is there. Of course, from an investor perspective, because they are not involved day to day, they still believe that having mortgage of the land and having all the guarantees, etc., is always a preferred scenario, because they feel that if my partner, if to the person I'm committing my money, and if they have done their legal work in a proper manner, then debt is something where the money will come back. So they still, as of now, prefer debt way of investing. And if you are able to generate that kind, if you are able to generate good returns in debt by investing with developers, I think they're still averse to giving pure play equity money. Maybe mesh kind of structure is something now they are able to appreciate, that part is fixed and part I'm riding an upside. That is still, there is still some acceptability. But pure equity, I think as of now, investors are not very keen to, give a blind pool of money to invest as pure equity.
Interesting point, Anand. Uh, uh, we spoke about consolidation, and I think developers today have opportunities across multiple asset classes. We have seen diversification from two ends. One, going to different markets. We have seen developers now moving in, pan-India, south base moving to west, west moving to north and south. And second is from an asset classes perspective. There are opportunities on office side, logistics, and data centers. So maybe Sangeeta, coming to you from a developer perspective, do you think it's now prudent and developers are kind of exploiting this opportunity to kind of diversify? And then developers we're talking about who are now better governed, who have the entire system to do it, to go to newer markets and also to explore newer products. Unless maybe a few years back it was, if a Bombay-based developer, residential, mid-market, only that. Right now, is you're seeing more wide-based diversification. Are you seeing that trend happening across India?
It's quite interesting. It's paradoxical. Sometimes some developers who went, and I'll talk about all real estate asset classes. In residential, some developers have seen when they went all over the place, they really went all over the place. Because residential real estate is a very micro market, if I may say, business. So that has happened. So many real estate developers who went all over the place are now trying to be in one place. And there are some, if you see especially from the south, who are coming and trying to conquer the other parts of the world. So I don't think it is about one rules fits all. It's how you conduct your business, how you build confidence, and how you have partners in other parts of geography. That's how residential has happened. Whereas commercial is a little less micro-market dependent. It's more about how much capital you can infuse and you know what's happening in the commercial real estate. And therefore, geography is not such a big thing. While there have been some saturated geographies in commercial, now you will see, so those same guys are feeling more confident about coming to other geographies as well. So what I would like to say here is, yes, people are wanting to diversify. Having a portfolio in any business, let alone real estate, is a good one. And if you have annuity and development, it is a good thing to have. We personally, and in our company, we do that. Even in my earlier company, we have done that, and then we have converged, and again we are looking. It's all about opportunities. It's all about capital, and it's, do you have the resources? Only in residential, one has to be very, very careful, because when you go to alien markets, because markets can be alien, if you don't know the rules of the game of that market, then it can be a deterrent. That's how I see.
There is no pan-India play? Is there
There are people who are doing pan-India and residential as well.
I can't think of more than 3 people.
Not 30. As it is, you see the number of players you have.
Yeah.
Who are the big players? You have to count on your fingers. Sometimes we kind of deter that, okay, I wish I had less fingers. So that's the kind of play in the real estate market.
Yeah. Tina, your view.
This is sad.
Sorry.
This is sad.
This is sad. I'm not.
In a country like India, you have just handful of developers who are present across India and
Piped up. Since you raised that, there are two, three profiles of developers. So you have, and this developer is a distribution game, so the word came as a Freudian slip. So you have developers who are the large ones, who are few. But if you go, in fact, I was attending a management conference where I was supposed to speak in one of the IIMs, and I was so thrilled. These were young boys and girls who were developers in tier 2, tier 3. So there is that movement which none of us in this room are even maybe so aware of. Young people, young generation, starting in places like Raipur, Bhubaneswar, Cuttack, and I was so thrilled. So please let me tell you, there will be some phoenix rising from the ashes there. So all of us have to be very and careful. So I just wanted to tell you that movement is also happening, which is a bottom-up movement. But I was talking about the top-down, which is obviously very sad, being a large country.
And also, Tina was just coming to you. So you all have, a portfolio across office, development, development management, residential, right? And maybe, you may do logistics as well. Is diversification across markets and across asset classes is the mantra? Obviously, there is opportunities, but for a stable, we're talking about stability of the platforms, whether on the developer side or on the investment platform side. Do you think that adds stability in a market like India?
Certainly does. It insulates one from the various cyclicalities that real estate is subject to. I think real estate is a very local game. Like Sangeeta said, there are very few pan-India players. You can count them on their fingers. So for us, partnerships are key. So because it is a very local game, you have to identify the right local partners that one can partner with and diversify, whether it's the geographical footprint or it is an asset class.
Same thing if at all we talk about the investment platforms. Developers need diversification maybe, right, for stability. Even the investment platforms also need stability, right?
Absolutely.
And diversification maybe across products, whether it's debt, equity, or investing in different asset classes, right? Do you think that also is evolving from the investment management perspective?
So yeah, see, what we do is that we specialize in residential investments, but we diversify geographically. So this is our, more of diversification policy. So the focus is only one asset class. We cannot have a different asset class with different geographies, so it becomes difficult sometimes.
Amit, your?
No, I have to agree. I mean, if as every investor is an animal, and he has a certain, either he's a domesticated animal or he's a lion or a tiger, and they have their own feed, what feed they want. If you say, "Kya re, bhai, you can go and also graze grass and also hunt," wo nahi hota humse. So there are hunters, there are investors who are hunters, and there are people like us who are happy with, getting small grass feed and small returns also. So I don't think you can change your DNA as an investor. I think people who think they can work across asset classes, it's a very different DNA required to do commercial office. I mean, a Blackstone has done it for decades with billions of dollars. They've developed their DNA. It's hard for me to do that. And somebody who's done a retail platform, like Shore, whoever, they understand that asset class. They know how it operates. They know its cyclicality. It's a very different feed, a very different DNA to be that animal. So I think, if we believe that we can just put on a cloak and, a monkey will become a tiger, wo nahi hone wala hai. So, we need our tricks and we know our tricks.
But from a developer standpoint, does it give you comfort if a developer is more diversified and a developer who is more, a region focused or a one product focused?
No, I don't think also that is an option, honestly. I think, again, if a developer is a circus and he's got all animals, then fine. Because he's got a different platform, a different DNA, a different talent pool for an asset class, which you can identify. But if it's fungible, it doesn't work. You can't say, my project head can also manage resi and commercial and retail. There's no such ringmaster who can manage all animals. You need a very identified, clear, separated vertical, which are three different boxes who don't talk to each other also. Then you can say, okay, I'm a conglomerate, I can do A and B and C, and you can identify them, and they're effectively three different companies with different DNAs, and maybe three different promoters of the group even handling it. Then I can say, okay, maybe then. But otherwise, it's a recipe for disaster. You see, enough and more people try and chase the next trend. यार कमर्शियल है तो बना लेते हैं, अभी रिटेल भी डाल लेते हैं, अरे वो अफोर्डेबल भी कर लेते हैं, अभी लग्जरी बन रहा है तो वो भी थोड़ा बड़ा घर भी बना रहा है, नहीं है तो फिर कट करके बेचेंगे, नहीं तो जोड़ी कर देंगे. I mean, वैसा नहीं होता है बॉस. It's not that simple. So I think you have to understand your DNA, what you do best, stick to your knitting, be the best at it, and then if you have spare capital, invest into growing a new enterprise outside of yourself. Then you're an investor in that platform, effectively. You cannot be everything at once. I mean, I've seen three brothers do three different things, and they don't understand what the other guy does. Very different mindset. So that makes sense. Otherwise, it's a mess, boss. I mean, you want to get caught in that mess.
So before we, go to audience, I just one question for Anand. from a capital stack perspective, you have banks who do more development financing and construction finance. We have very few funds or AIFs who've been doing, land and, pre-construction approval stage. How you see this, scenario changing, or we always are we for the foreseeable future? Are we going to see only these limited players doing financing for land and maybe pre-construction stage?
No, I believe that with the markets turning around, and after a lull of almost 7-8 years in Resi, with the markets turning around, and maybe of course we are facing some headwinds as well. So we'll have to see what happens in next 6 months. But if things remain the way it is and remain stable, I'm sure we would have lot of investors, lot of funds coming in who would be investing in land, who would be okay to give money to developers at land stage. Because largely, in fact, yesterday we were having a discussion, and over whatever we have funded in last 8 years, and we have funded more than 100 projects, 125 projects to be precise. Barring 1 or 2, we have not faced any approval risk, or the project has not received approvals and the project is stuck. We have not seen any scenario. So the approval risk, which was perceived in 2014-15, that has changed significantly. If you are doing things in the right manner and you do your due diligences, the approvals will be there. So the money has to come at land stage, because that is where the maximum capital is required. Today, the way the sales are happening, no developer needs money to fund the construction. So the capital will come at land stage.
I think it's an important point. I think this should be marketed. I think it also goes to a point of underwriting. Maybe underwriting was right, and whatever perception we have that approvals don't come in different cities, it's if at all you underwrite it correctly, if you underwrite your risk correctly, you are bound to get it. Maybe we can open the floor for questions from the audience.
Hi everybody, which has been a fantastic, enlightening 3 sessions from morning. We have all the best of the developers and the funders and the the asset management companies. What I've noticed, this is my personal perspective, we've been speaking about the upper or the topper, the elite developers. So we have the best developers, we have the best fund available, we have the best asset management companies. What about where India is right now? And Sangeeta just mentioned about the tier 2 developers. That's some change happening. How are we going to be addressing, which I still believe is a major problem? I represent even the channel partners, so we can see one side we have all the 3-4 bigger companies getting bigger and bigger and bigger. Similarly, the same thing is happening for the developer. So I think that's one major problem which as stakeholders will need to address. There are multiple asset classes, there are multiple cities. We're talking of developers going, pan-India. We have developers from South India coming into Mumbai. But what about those so many developers who are actually struggling to complete their project because of lack of funding?
स्वामी फंड है ना भैया उसके लिए?
लेकिन स्वामी कितना फंड है यार?
अरे बहुत है यार,
25,000 करोड़ है खाली.
बहुत है, और 25,000 देंगे, उनका वही खत्म नहीं हो रहा. They're not able to deploy 30,000 crores यार. Next 30,000 crores will come. See boss, very simple. Private capital, which is not a social impact fund, it's a social impact fund. Government of India sponsored. Very different objectives. We are for profit. For profit will chase the best profit and the best deal. So if the best deal is there in Bhubaneswar, I don't mind. But cash में नहीं लूँगा पैसा बॉस. बैंक अकाउंट में दे सकते हो, मेरा पैसा अवेलेबल है.
It's a big problem, right?
What is the big problem?
This where the developers are not getting the funds, according to me, this is my personal thing. I'm not, obviously not authority on that.
Yeah.
But we've been able to address. So we have the Blackstone, we have the Hines here, we've got Runwal expanding. We have all this. And since morning we've been talking about that's a good part about the industry. We are getting consolidated. But somewhere I still think that we are missing out on those the so-called, the SME developers, the SME channel partners.
No. I'll disagree with you. I have tried very hard to go and, just out of experiment say, I don't want to give to the 7 metros. Let me go to Raipur, let me go to Cuttack. वो बोलते sir land लेने का है तो पैसा डालो. I said I'm not investing in land. He doesn't want construction money.
They don't understand the language.
They don't want construction money. And if you offer construction money, say, yeah, sir, 10, 11, 12 में देते हो तो समझेगा नहीं तो I don't want. They don't want your capital. They don't want private equity. They don't want to share
Realty
profits.
Plus will have to have a separate session to educate them now.
No, I'm sure you know them so well that you'll be able to do a better job.
I'm trying.
But I'm telling you, they don't need. We were in Gujarat the other, 3, 4 of us.
Yeah.
And we were facing the same problem. Everybody's selling, everybody's earning money. They have taken half of it home, half they're putting in the bank. पता ही नहीं agreement value क्या है, sale value क्या है. It's a real problem, boss. I'm telling you, it's not an issue of capital. It's an issue of the DNA, the discipline, and their need. They want free money, cheap money that is somebody else's risk. Profit is mine, risk is yours. That doesn't exist. I'm willing to put even 20 crore rupees and take one project in Raipur or Cuttack or Bhubaneswar, wherever, if you can find me the right guy. Who's not somebody who's retired from a state bank says, I've done 1,000 crores of loans, तो अभी मैं developer बनूंगा. उसको भी नहीं मिलेगा बहुत पैसा. आधे तो ऐसे ही आ जाते हैं, wannabe developers. ये सबका माल बिक रहा है, मैं भी बेचूंगा. Boss, I mean, let's get real. There is money. The quality of fund seekers is zero. I'm willing to debate this with you with any person that you can bring to the table and willing to take money in tier 2. They don't want. They don't want to account for that money. Who's going to pay tax?
See, fundamentally and historically.
No, I'm saying he's a friend, so I can talk to him across the table. But I mean, see, there are constraints in the system. I don't think the demand is real, talent is there, capital is there.
Be kind of institutionalized or ready to get funded. I think there's this little gap which I understand.
Sangeeta, you're right. And I think all of us, what we do in all of these is through these forums, we tell you what we need as the check boxes. That's all we can do. And which is why our choices get limited. When I'm saying I'm able to address only 3% of the opportunity set, it's not because I can't raise more money. It's just because that 97 gets rejected for multiple other reasons. That's the constraint. So yes, capital is limited, but we'll endeavor to find more capital if we can find more quality. I think Mr. Power is sitting very quietly there. You should be asking him all the questions.
Any questions? Further questions? So I have one last question, right? And maybe one-line answer. How do we see interest rate in next 6 months? Well, that is one thing which will impact financing, developers' growth, sales.
I think it's a cautionary environment as far as interest rates are concerned. We should be overly concerned that it's going to cause any meltdown. It's going to cause. I don't think it's going to cause any meltdown or any reversal of trends in the short to medium term. But yes, I would urge everybody to be very, very cautious. I think that caution is going to come into the buyer's market. I think it's definitely coming in the lenders and the developers market.
Anuranjan?
I think times could be tough if, world economy has, the US interest rising and money flowing back to US, and this can create a disaster. But so next 6 months could be very interesting. We need to be very careful, very watchful of global event. And in India, I don't generally fear that, the interest rate will be more than 10%, 15, 11%, what it was earlier. So our inflation is in control, but our impact will be more of because of the macro environment across world. So this could be a impacting thing.
Want the funding right to say?
No,
I
please.
would go with Amit. I would watch what's
Cautionary.
happening. It's cautionary. And the lack of interest of consumers will also determine how the interest. So interest is related to interest.
So I agree with Amit that it's 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 uh, it's getting scarier day by day. So we'll have to wait and see. But what is also happening simultaneously is that people are also witnessing a bit of capital appreciation as well. So that is as of now offsetting the impact of increase in interest rates, or that my home loans have gone up because my capital value is also going up. And then now with the way the markets are turning, there is a FOMO thing also coming within the consumers. So as long as capital value is also moving, I think it will take care of the interest rate.
Last word from the finance.
Yeah, I think interest rates will continue to rise in the near term, then hit a peak and start coming down. But if I were to offer a counter perspective, look at another emerging market like Brazil, where interest rates have gone from sub 3 in 2021 to now just shy of 14. So we are a lot better placed, and therefore, we should not be scared about these short-term trends. Look at Russia, China. Yes, it's only India shining.
I would be very wary of calling India shining. I remember what happened sometime back.
No, I think on that note, I think so.
Always believe that this time will be different.
We end with lot of positivity. We are definitely much better off than a lot of other emerging markets. And as in the panel said, we have a lot of opportunities coming up. Developers are expanding. Market has got consolidated, so there are better governance. Operational excellence is now coming in, and hence investors will put in money. Capital is available, so developers will grow. I think on that note, I think we'll end the session. Thank you all very much.
I request you to please remain on the stage. Ma'am, sir, I'm going to request you to kindly remain on the stage. And can we have a round of applause, because I just love how our panelists were also enjoying deliberating and discussing amongst themselves. And may I now please invite Mr. Subhakar Rao Surapaneni, Chairman, Champion Infratech, and Colonel Govind V. Rajulu, COO, Champion Infratech, to please come on stage and also present a token of gratitude to all of our speakers. We're going to request you all to please come together for a group photograph as well. May I request everyone to please come together for a quick group photograph.